Good day, everybody. Brian here, quantlabsnet.com. I'm just going to show you probably the last of the Python scripting files for futures and options. In this one, I'm going to focus on kind of not really, well, I won't say it's really Forex is retail. So always remember that. Forex is retail. Currencies is what I'm more focused on from a futures and options standpoint. I want to show you first the size of the fiat currencies out there. Okay. So this is all listed in Bitcoin. So the largest, obviously by population, will be the Chinese yuan. And then number two would be US dollar, euro, or euro dollars, you're about to see, and then Japanese yen. Anything after that, I'll just leave it at. All right. So let's get into our, let me just get rid of this guy. All right. So here's some of the scripts that I've written. That's why it takes a long time to see the amount here. It's a lot. But this one is just purely focusing only on treasury, bond, like treasury bond, all that, in yen and euro dollar by the market size I just showed you. So one other thing I should show you is the size of the U.S. Treasury. So this is all in euro, U.S. dollar. Some of it's already when they print money, so this is, in my mind, artificially inflated. But the issuance at $5.2 trillion and the outstanding at 28 trillion. Remember, that's all fakery with printing money, but that's the size of the treasury market. So coming back here, I have a list of the scripts I want to show you right here. So I think I'm going to start with the yen. It might be best and easiest to do that. So in the world of Python scripting here, let me just show you some of the not final, far from final. This is all in development, but just to show you independently of each angle you can look at. So let's first look at the yen futures, just as an example, because that's a fairly big um, asset out there. So here we could have a price of 93 cents against the Japanese yen. Everything is measured in price change in yen, zero point zero 0.01 yen. And then in this case, we could have a 1250 uh, a profit loss on this kind of contract. This is just all simple make believe. So again, I've talked about the arbitrage, hedging, all that kind of fun stuff. So here, if you do a long position or buying profit, if yen strengthens, or the short position or selling, if the dollar strengthens, future prices decreases. Okay, that's all fine. So in here, I can show you a payoff diagram. I've probably shown this before. Let's just see if it generates something here. Yeah, so again, not much can be said here because of the decimalization on the yen and all that. So I'm not going to bother with that. But let's see if I could see one of mine that I've kind of played with here. Um, so anything under underscore CHG is the one I'm going to implement into my little reporting system. And let's see if anything like that comes out. Oh, you know what? Screw that. So, anyways, let me show you the time value on a yen contract. At least we can get that kind of running. Um, there you go. So if you have a time value per yen at 0.01, the industry standard for contract size on yen is 1.25 million, and then the total time value is 1250. So that will decrease over time towards the expiry on that option. So let's start looking at the euro dollar. It's basically euro dollar is all the dollars that are stored outside of the US, typically in excuse me, in Europe. And let me show you some examples here. So let's do first the euro dollar quotes. So here, very simple. You have a quote of 99 euro against the dollar, and then you have your implied interest rate, which is your volatility. You could get that measured. Um, and then let me just show you another one for a futures contract. Not sure if this one generates a chart. Oh, it doesn't. So let's say if you have an overnight rate or a LIBOR rate at 6.82%, futures price at 93.18, the contract value, and remember it's always in a million, and that's why I'm not all that interested in these kind of contracts or instruments because they're huge. I mean, Treasury, you'll see it's $1 million for a contract in the futures market. Same with the euro. So don't look at me to do that. The workaround for that is basically go into the a uh, retail forex market. Depends on your broker. In my case, what I'll be doing with the system is everything's going to be in U.S. dollar because I'm going to be honest, I just can't be bothered to have X amount in this currency and X amount in that currency. I just want to keep it all simple and just do everything in U.S. dollar and only have whatever looks good trade in U.S. dollar. So I just want to make sure I stated that. So here after this contract here, you got 982, 950 that's left over. As I said, it's fairly simple stuff. But let's take a look at the euro dollar quotes. I didn't show that. So here again, yeah, I showed that. The hedging, and I've got a whole video dedicated to the hedging. So here, if we have a deposit value of a million, and again, that's per contract, number of euro dollar contracts sold to 10, current euro dollar future price at 99, new euro dollar future price after a rate increase at 97. So if one of the central banks increases or just changes the interest rate, what's left? Profit from the short future position at 1980. So again, you can do those sort of things. As I said, on the futures market, when it comes to uh, if you're anticipating a rate increase in the Fed or the ECB, because it will impact the euro dollar relationship and the value of those contracts. The last one, I think we're all done with that. Yeah, we're all done. Okay, so let's move into the Treasury. There's a bunch here I could look at. So the T-bond is an interesting one as well. So these are all payoff diagrams. So let me just pull one up. I'm not sure if these will have any meaning. Again, this is nowhere close to final. This is just to show you what's coming. Uh, One thing I will say, yeah, so you have a T-bond here, call option payoff, the strike price, boom, and then the break-even point as well. So that's the nice thing about these payoff diagrams. Again, that might not even be real world or current, but just to give you an idea that you want to look for the break-even and what the current price is, and you use that as a tool to analyze if you want to take those positions or not, among other types of analysis, as I've shown in the last, I don't know, couple of weeks of my YouTube channel. All right, so there's that. Let's see if we could pull up another one. So let's see here. We got T-bond payoff uh, diagram change. So this might be similar what we looked at. So this is a little different here. So here, if we put a long call option or a long put option, we can see the difference here against the strike price and the break even, which is not displayed anywhere. But again, just knowing if you want to do a pull or a put or a call option for these type of things with a profit and loss on there as well. All right, so let's check out some more Treasury fund stuff. And again, these are big boy contracts, a million plus. I don't think a lot of people watching this will ever go into that unless you're from an institution. But let's check her out. So let's run the first one here, Treasury bond hedging change. Okay, here's another one. So again, we have a $1 million dollar contract. Now, I keep mentioning this. The important thing is this notional value. A lot of people don't pay attention to that. I mentioned that in yesterday's video. Very important to know what notional value is. Um, Future contracts sold, 10. Loss in a mortgage value due to an interest rate increase. So this would be something like for a realtor or a real estate or a commercial developer in buildings. So they use these kind of contracts. So if they're going to take a mortgage out against the current rate, and they put on positions to sort of hedge against any future loss, they can do that. And then in this case, if there's an interest rate increase, they would lose 50,000 on a potential mortgage, but they could profit also in a futures position as well. So they could kind of offset the value of the property uh, along with a future a a loan that they may have to take out against the building or to do something to the building. So they can kind of hedge to protect themselves for that. All right, so let's take another one. Treasury bond put option. This is another way of doing it. Um, with the put options as well to protect yourself down the road. But again, you have to make sure you have the call right. So here we have a put option we're putting out. Strike price at 104, future price at 114, premium 43.44. And again, that intrinsic value is very important, and then the time value. So to really understand where we're at a snapshot and where you want to look at for a future contract option, whatever you're looking at. And I believe we have a chart here to look at. Let me just pull that up as well. And again, oh, yes, this was an important one as well. What I wanted to show, I showed this at the start of the whole thing here about the treasury curve. You can see it's fairly flat, which is actually a good sign instead of decreasing. These are your maturity dates on the treasury versus the yield. You can see it's fairly flat. Like you want it, you if you want a healthy market, you want it to be normally curve, like a normal curve. But if it's inverted, that's like watch out. And I've said before, once you start to see the 30-year versus a short-term treasury start to um, diverge in a significant way, you got real problems there because that credit spread starts to get bigger, and that's when the U.S. has got real problems fundamentally in the economy and at the treasury level, and it's just another way of saying, a nice way of saying, good night, Charlie. Okay, so I know I have some other scripts here that we can look at. Now, a lot of these I don't work on for my system because there's no point in doing it if the contract sizes of the Treasury contracts are $1 million. I haven't looked to see if you can do. I think there's some mini ones you can do, and those are probably right now in the economy, being March 20th, 2025, for short term, 3 month, 6 month Treasury or T bill, hold out in that and sit it out in that where you can still get and collect a return on that, which is guaranteed. But beyond that, you know, as a lot of people already talk about where the Treasury status is, and the U.S. government, the Fed has been printing money like drunken sailors. It does put the Treasury, the U.S. economy, government, all that at risk, meaning they could default. And then again, it's good night, Charlie, because of that. So let's take a look at a typical bond quote, which is usually displayed like this, not with a decimal, but fractional. Bond quote would be that you'd get on a system, and then the dollar value of that bond. So let's take a look at the pricing. And again, I don't think I'll use these kind of things because this is like institutional level at big money. So if you have a bond price at 4%, market yield at 15,000, which is the premium, bond price at 8%, market yield at 7,500 at the discount. So there's a lot of math behind that. I think of all the assets out there, instruments in the futures market that's the most complicated is definitely Treasury. So for me, I'll just gladly stick it out. I have to do more deep analysis on it, but even if you're not in the futures and options market, the ETFs can be okay to hold as well. I think, but I don't know. Anyways, let's do one more. So we got price yield, and I think that's it again. So you have a final price at 15,232, 1460 final price at 115.2 over 32, 1150. So you have a price change of 14 over 32. This is the old school way of measuring it over 30 seconds. Dollar value of the price change of 437. So to get to this point, you have to do a lot of math in your code to get that converted over. Of course, you're going to have a brokerage fee, and then your profits, your $10 minus the 427. Again, all scenario and in development, but this is a pretty well, very practical way of looking at these instruments and the P&L, the profit and loss that you'll take on. All right, so let's see. I just want to make sure. Actually, I have a list here. I could just go through. I'm showing you the T bond, euro dollar. We've gone through, and that's it. Oh, treasury bond. Let me just show you. Let's see if there's any of the treasury bond as well. Okay, so we have a few here we can look at. Again, treasury bond hedging. And again, I've talked about hedging in another video, so check that out. Okay, again, I think we've looked at this similar. Yes, we have. Again, this is when the commercial developers are trying to hedge on a mortgage on a building. So they'll take out an extra type of contract in the treasury space to kind of hedge against a change in the interest rate. Let's check out another one, the put option. Yeah, we've already done these. All right. So again, if you like what I'm doing, what I'd recommend is go over to my website, quantlabsnet.com. In there, if you go under the at the top here under Learn, get yourself signed up there because this is where you get on my newsletter, and all your info is not released to anyone except me. You will get emails from me. I do send them out daily. It just depends if you want to engage or not. And yeah, so again, as I said, I'm working on a couple things here. If you go into the shop under plan and pricing, everything that I'm doing right now will become a basically a super report of the futures, of the options, what's moving. On top of it, giving you all the option stuff, I'll put out another video on it um, as well, on specifically options as well. But you get all that fun stuff. I also do micro, I do crypto. We've got a private forum section here as well. And there's also going to be the programming as well. So that's pretty low price considering, and I've gone on about the options chain data, which is very expensive, literally in the thousands per month. So to be able to talk about that, we'll see how that goes. So there's that. If you want to know more about this a course, so you can learn about the futures and options as an intro, I'd recommend you go into the store. I do have a small little course on that. Just give you a feel of how I teach, I guess you could call it. If you like it, then you like it. And we'll leave it at that. Thanks for watching and have yourselves a good day.